Welcome to the B.F. Anderson Technical Report for July the 15th. Standard deviation is just nothing more than a way to understand risk. You know, when things deviate, when you get volatility, that's the real risk. It's not, whether you're worried about a company going bankrupt and so forth, which is a risk, but the real risk is volatility. I saw a recent interview with Warren Buffett where he spoke about this very subject right here, which is where you can measure volatility and put a mathematical calculation together that says, okay, how many stocks does it take to minimize market risk? Well, he said 6 in his interview. He said 6. He said by the time you get to the 7th one, you really, what's happening is you're trying to eliminate mathematically market risk. Well, by the time you get to 10, you've pretty much eliminated the risk. And so with my experience, what I've noticed over the years is that, when I went to business school, we studied something called modern portfolio theory, which is where you bought 20 stocks, 5% per stock. But I never really could find that many. So what Buffett is saying and what I'm saying is, to find 10 good investments is a real challenge. And he even argues that by the time you get to number 7, you're starting to dilute the first 6. So just understand that diversification is a very important factor in your portfolio management strategy. But, you can over-diversify because there's just not that many good deals out there. Now, here's a report that was done by LPL Research. Basically says, okay, we've had 7 consecutive new highs here. Now, we're still, as of right now, we're still making new highs. And so what is this? What has this generally led to? Well, it goes back to 1955 and shows all the years where we've had consecutive new highs. And the average return 12 months later is about 11%. So it's a good sign. So we're seeing a lot of new highs in the market. Now, here is another graph where he says the long monthly win streaks. Now, we've had 5 months of a winning streak so far. Now, we're actually in the 6th week. But if you go back through time, and you may want to pause your video player, but you can see here that the average return 12 months later is around 13%. So the fact that the market's going up consecutively and making new highs consecutively is a very positive sign. So let's kind of get into the graph here. Here's the NASDAQ. You can see here we're continuing to hold that 10-day moving average. We're kind of maybe flattening out a little bit, however, looks positive. Here's the mid caps. Now you can see here where we're having a problem. We're not seeing a broadening out of the market. So, if you're frustrated with your portfolio because it's basically moving sideways, well, that's a lot of the indexes out there are moving sideways. But the media is going to focus on the NASDAQ. The media is going to focus on the S&P 500. But when you start getting into the mid caps, and then you get into the New York Composite, which is all the stocks on the New York Stock Exchange, this is basically a flat sideways market. It's not making new highs. Now, here's the small caps. You can see here with the small caps, the smaller companies, and this is somewhat of a warning, I would believe. We're pretty much rolling over here. The small caps are not performing. So what I'm just saying here is take the new highs in the large cap indexes such as the S&P and the NASDAQ, take it with a grain of salt. Here's the S&P 500 right here. You can see it's been making new highs, but it's not a broad new highs. That's somewhat of a negative. Now, here's the more of a long-term indicator. This is where we're using the 35-week moving average. Everything looks fine on the NASDAQ. S&P, everything looks fine. We're in good shape here. Now, on the aggression index, we can see a little bit of a softening here, a little bit of a turn down. Nothing to be too concerned about at this point because we're above that 40-week moving average. So this particular indicator, which is comparing consumer staples as a ratio to the NASDAQ. So we're comparing soap to technology, and anytime this particular indicator gets in trouble, which it did here as of February, it's just telling you that the market is not really it's defensive, it's not aggressive. Now on the interest rates, we're at 1.36 on the 10-year. Treasury note, again, interest rates are staying considerably lower. Oil, however, kind of creeping up a little bit. We're going to continue to see oil stocks making the top 5, so we should keep an eye on oil. It's continuing to stay somewhat in an uptrend. The financial stocks have somewhere flattened out, kind of in a way have turned down because interest rates have turned down. Now, it's kind of like this. If you're an oil man, you want to see higher oil prices. If you're a bank person, you want to see higher interest rates. And you're just not seeing higher interest rates right now. Now, the new lows, we're in good shape there. We did see somewhat of a spike here about 4 days ago. However, settled back down again. On the yield curve, we're not seeing any type of inversion here. However, we are seeing somewhat of a flattening out of the yield curve as interest rates move lower. Here's the AA bull-bear ratio. We've kind of moved back a little bit more into a neutral zone. This is a very positive thing. Here we have the put-call ratio. Still in greed, still frothy. Would like to see it get back up at least into the neutral zone. However, things are optimistic. Now, this is the comparison, a ratio comparing the inflation-protected bonds to the traditional bond. You can see inflation considerations or fears were building over an extensive period of time. We've made a high, lower high, lower high. Now we're starting to kind of flatten out a little bit after making a lower low. I just think the market's saying inflation is just not a problem right now. Here is the Russell 2000 Growth ETF. You can see here the growth stocks are continuing to have a tough time here. Now, one thing is this. You can have a growth strategy or you can have a value strategy. Not either strategy is not going to work all the time. If it did, then that's just what everybody would do, and then it wouldn't work. Point is, growth stocks have been under pressure since about February of this year. Not seeing much relief yet, but just hang in there. Now, here is the comparison of junk bonds to treasury bonds. Again, we're seeing somewhat of a rollover here. So I'm seeing more signs where the market is more concerned about deflation than it's concerned about inflation. Volatility index continues to stay in a very reasonable zone. No major change there. Now, I wanted to go back and look at something just to make a point about growth stocks. Growth stocks peaked on February the 10th of this year. So they've been going into a consolidation. Now, think about it this way. You have a big Christmas dinner or you have a big Thanksgiving dinner. What do? You go lay on the couch and take a break. You consolidate. So in other words, the growth stocks had a major rally. Now what this is a ratio of the Invesco QQQ, which is the top 100 NASDAQ stocks, compared to the S&P 500. Well, you can see here at the beginning of 2020, this ratio basically took off, which means that there's a lot of outperformance here. But ever since then, it's been consolidating. It broke down below the base, pulled back into the base. So, in other words, I'm saying that this ratio that I'm showing you is more of a descriptive ratio. I'm not trying to predict anything. I'm just simply saying is no strategy is going to go outperform another strategy forever. There's going to be periods of consolidation. Now, here's another example. This is where I'm comparing internet stocks to the S&P 500. You can see big outperformance, consolidation, breakdown, pulled back into the base. We'll just have to see. I'm just saying that growth stocks have cooled. Now, the Fidelity Information Index, Technology Index, same concept. We got big outperformance against the S&P. Now we're going into consolidation. Will the tech stocks start to outperform again? They probably will. But right now, as we speak, that's just not happening. We'll look for a breakout. Now, this is the ARK Innovation Fund. This is one of the hottest technology funds last year. Again, you can see the comparison to the S&P. Major outperformance, then major drop, starting to consolidate. Again, the tech stocks and the growth stocks are just going through a cool down phase after being red hot. Now, the top 5, we're still seeing some energy names here. This is Matador Resources. Again, basically moving sideways, not making new highs, But this group continues to be strong after being strong for quite a while. Here's L Brands, which is a consumer retail, LL Bean, basically. You can see here broke out above the 10-day moving average, continues to be in an uptrend. Here's Antero Resources, another exploration production company. Again, you can see moving sideways, really not making any progress. Here's Asana, which is a software company. Now, one thing to realize about these software companies, they're all going to a subscription business plan, which means they get recurring revenue. It's really a sweet business. I would look very hard at these particular companies. This is where we may see the future growth. Anyway, this is a very positive pattern. Asana looks very good. Here's Continental Resources, another energy play, again sideways, kind of breaking down a little bit. I would just say I would kind of keep a close eye on the energy stocks, but they are kind of in a difficult spot. Let me know if you have any questions. Thank you very much.